Since the start of the year, the Indian rupee has slid by around 11% against the US dollar, even slipping past the 83 per US dollar mark in October. But over the last week, the rupee has strengthened against the greenback, albeit marginally. So is the rupee set to recoup finally, or can it slide any further? You're watching Nuts and Bolts by Forbes India with me, Varsha Meghani. Minister Nirmala Sitharaman now famously said that it's not the rupee that is falling, but the dollar that is strengthening. Her statement led to a rush of memes on social media, but she was in fact technically correct. It's not just India, but all countries, advanced and emerging, that have been impacted by the US dollar's rise. India, in fact, has been a relative outperformer. The rupee has weakened by 11% against the greenback since the start of the year. Compared to other currencies such as the British pound, the euro, the Japanese yen, and the Chinese yuan, which have all slid by 15 to 20%. The simple answer is inflation. During the pandemic, the US Central Bank, the Federal Reserve, printed a lot of money and distributed it for free to support its people. At that point, they didn't have much to spend on. But as the economy opened up post-COVID, they began spending it. The pent-up demand of 2 lockdown years, coupled with broken supply chains caused by the pandemic, led to a spike in the prices of goods and services. As these went up, inflation went up. Inflation soared to 9.1% in the US earlier this year, the highest it's been in 4 decades. Presently, inflation stands at 8.2%. In a bid to control this inflation, the Fed has been aggressively hiking interest rates. As a result, US Treasury yields have surged. That means a 2-year US government bond, which earlier fetched 0.25% last year, now fetches 4.4%. So investors are pouring money into the US. As money flows into the US, the demand for dollars increases and the currency strengthens. But in the last week, the US dollar has been weakening and the Indian rupee strengthening, albeit marginally. The rate stands in the 81.2 rupees per dollar range, from earlier slipping past the 83 per dollar mark in October. The rupee's slight uptick is because of 3 broad factors. Number 1, crude oil prices are easing off from about $110 to $115 a barrel to sub-100 levels. This means a lower import bill for India and less pressure on the Indian rupee. Number 2, in the last week, the dollar index, which measures the value of the dollar against a basket of 6 currencies, dropped from above 113 to below 110. A weakening dollar leads to a strengthening rupee. And third, domestic equities are seeing a surge in inflows thanks to the China substitution effect. China's zero-COVID policy, the lackluster performance of its domestic equities market, and its tiff with Taiwan has led investors to pull money out of China and pour it into other, more promising emerging markets like India. Not quite. Currency fluctuations of about 1 or 2 rupees per dollar are commonplace, and much should not be read into it. In fact, analysts see little respite for the rupee in the near term. According to Sajal Gupta, head Forex and Rates at Edelweiss Securities, quote, "This strengthening of the rupee is temporary. The US Federal Reserve is expected to further hike rates by 50 basis points in December. Until the US economy cools off and we don't see any more rate hikes, which might be well into the summer of next year, we don't see any sustained relief for the rupee. That said, we might be on the last leg. Rupee depreciation should halt at close to 84 rupees per dollar." End quote. Contrary to popular perception, the best thing the Reserve Bank of India can do at this point is to let the rupee weaken. Think about it this way. India is a net importer, and the trade deficit we're staring at this year, that is the difference between India's import and export bill, might well be as high as 3% of GDP. In a world of depreciating currencies, if the rupee doesn't move, it would become stronger relative to the other global currencies. This would make our exports less competitive, thereby hurting job creation and overall growth. So letting the rupee weaken in a calibrated manner by prudently drawing down on forex reserves and gradually raising interest rates, which is what the RBI has been doing since September, acts as a shock absorber and gives us the necessary competitiveness vis-a-vis other countries. As the IMF says, India is a bright spot, but not without caution and careful currency management.